Welcome to the show, Money in the Morning with Mitch Goldberg. I hate when I do that. I have too many shows. Welcome to Be the Boss of Your Money. It's so nice to have you. This is a show where we take control of your money and we get to talk about a lot of things. It's not TV, it's live streaming, so we can get into a couple of other things. We can talk, we can chat. Hey, while you're watching this, give us a thumbs up in the reactions or leave a question. If you have any questions about what we're talking about, I love hearing from you. Or just say hi, let me know where you're watching from. It's the best part about doing this is knowing you're out there and you're saying hello, giving me a thumbs up, and this way I get to see who's out there too. It's really great. So I'm going to try to get to doing these meetings, these shows back to 4:30 one of these days. We'll make that my New Year's resolution. It's not a huge resolution, right? But we're doing it now, and better late than never. We have some really important things to talk about. Small cap stocks. Less than 60 days ago, the Russell 2000 small cap benchmark was at its 52-week low. Less than 60 days, it exceeds its 52-week high and reaches a new all-time high. That is really an incredible move, and it goes to show you, A, how powerful this rally has been and how broad-based it's been. It has not been strictly a large cap tech stock rally. What else? The Red Sea. We need to take a look at the map, what it means. Yemeni Houthis firing at cargo ships, what it means for global trade, and CD rates are falling. We talked about that this would happen. It's happening now, and this is why we talk about making sure you pay attention to the long-term rates from bonds, not just short-term instruments like money markets, short-term CDs, things like that, and T-bills. All right, let's roll the intro. We're going to talk about these now. Just to catch you up, and thanks for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. While you're watching, give us a thumbs up, a heart, or an applause, a wow button, whatever it is, depending on which social media platform you're watching. I love hearing from you. It's the best part about doing this whole thing. If you have any questions, I want to answer them, and I want to build a relationship with you. Let's first give you a quick catch up. Stocks were going down 3.5 months straight through the last week of October, and then the stock market started to happen on anticipation of the Federal Reserve doing a pivot with interest rates. I've been dying to use that one. So we get to the Fed, we get some inflation figures came out lower than expected, moderating inflation. In fact, inflation has come down a lot, to the point where it's running about 3%, but still in historical terms, not a heck of a lot, and the Fed would like to see it go lower. But I think the Fed is actually worried now that inflation could not only keep falling, but it could fall a lot more. And that's why we had the Fed meeting. The Fed had its post-meeting comments and commentary from Chairman Fed Powell. And it looks like the Fed wants to, or is anticipating, cutting rates 3 times next year. We were calling on this show 2 to 4 rate cuts next year. And I've been saying to you, that it doesn't really matter if the Fed cuts 1, 2, 3, or 4 times next year. The point is they stop raising rates and they're going to start cutting rates. The longer it takes them to cut rates, the more anticipation the market has about it. And quite frankly, that could actually keep the rally going longer than just cutting the rates quickly and getting that done. If the Fed cuts rates too quickly, it's an indication that we have problems. So we don't want rapid rate hikes like what we had. We don't want rapid rate cuts like we think we could be getting. So this is the balance of where we are. The economy is expected now to not go into recession, but to slow down enough to bring down inflation without causing inflation. Soft landing. And this has driven the stock market a massive amount of upside. just massive in the last, since all of, for almost 2 months straight. Now we have major averages. We're up 7 weeks in a row. By the way, you can't invest directly into an index, but you can invest in a security that tracks or mimics an index. We're looking to see the Dow go up maybe an eighth week. The Dow went up 7 weeks, first time that happened, I think, since 2017. I don't remember the last time the Dow went up 8 weeks in a row. But after today's rally, it's only Tuesday, but we could be working on an eighth week. It's hard to believe it's only Tuesday if you've lost track of all time and space because it's the holiday season. You are not alone. People today were saying to me, have a nice weekend. I'm like, it's Tuesday. And I want you to know something about the show. I appreciate you watching the live stream. If you miss it, you can always catch it in the replay. It stays on my timeline. So if it's 9, 10 o'clock at night, you want something to do, go to my timeline, check out, see if there's a new live stream episode up. I post videos or a live stream almost every single day. So there's always something to watch on my timeline. It's all educational. It's all fun. And I encourage you to watch it, like it, comment, share it with your friends, and let everybody enjoy the wisdom that we're sharing here. I have over 30 years of experience as a financial advisor. I know a lot. I've done a lot. And I always tell people this. We learn the most from mistakes, but you don't necessarily have to learn from your own mistakes. I can compile all the ways that clients have overcome challenges, the way I've helped them overcome challenges. And quite frankly, I learn a lot from my clients over the years. You put all this together, it adds up to a heck of a lot of sharing of wisdom on the show. In any event, markets continue to rally on the soft landing scenario, but I do want to put out a warning label here. If you are someone who has been down and out in the stock market, and I want you to know the market negativity was so bad, the investor psychology a few months ago, that I had friends who were not clients of mine who were calling me, asking me, should I sell? Should I move my 401k into cash? Should I just wait it out? And, all hell broke loose in the Middle East with Israel after that horrendous attack after Hamas. The one where Hamas runs into Israel, kills 1,400 people, and then they run and hide behind people and expect to get away with it. And Israel should do nothing about it. Of course, if Israel did nothing about it, they would let every terrorist organization know that all they have to do is attack Israel and then run into a city, and they have carte blanche to do whatever they want. That would be a terrible message to send. And it's terrible that, okay, the whole thing is terrible. I could say the Palestinian population voted for Hamas. They're right under their nose. Well, story for another day. Okay, I stand on the shoulders of what's going to be historically correctly judged. So let's go on a little bit. What we have to, I'm having a cold so bad. Oh, it's getting worse. What we have to take a look at now is the averages are up a lot. If you're in a position where you were overinvested and you were worried about the stock market, about your financial future, about your wealth, and what happened in the stock market really, really messed things up for you, then you could take a look at where the stock market averages are now, where your portfolio is now, and now would be a time to consider either rebalancing or plain old raising some cash. This is not a market call. I'm bullish, but then again, I'm a perennial bull. I believe that over time, the economy and the stock market grow, and I'm in it for the long term because I believe that saving money is a worthy and noble cause, but saving money is not going to get you rich, at least not rich enough to retire. You need to invest. That's what I believe. That's the whole nature of the stock market, isn't it? That's the whole point of investing. So, but if you sold out everything and you just sold stocks and got rid of all kinds of stocks, you sold Nvidia, you sold Facebook, you sold Boeing, all these big winners, and you sold your small cap stocks, and now you see this huge rally. Well, if you missed it because you sold out, it's because you weren't investing in the first place. You should never be in a position where you have to make the decision of having to buy now or sell now. You should never have to be in that position. You should never be forced. You should never feel like you have to react to a market move, a recession, a bear market, a bull market, etc. You should be invested according to your needs, your goals, your time horizon, your risk tolerance. There's quite an art to figuring that out, and that's what a financial advisor helps you do. And then, since you're invested appropriately for you, you're not going to feel forced to sell everything when the market goes down, and you're not going to feel forced to buy everything when the market goes up. If that's the case, it's because you have lost control of the investing process. You need to gain that back. And that's what this show, in part, is all about. So, having said that, if you have financial obligations coming up, your money's overly invested in the stock market, and now your accounts are up a lot, now could be a time to consider raising some cash. Don't be complacent. We will have another down market, or this market could keep rallying. We don't know, which is why you need to raise a little bit of cash if you have upcoming financial obligations and you don't have the cash because all your money's invested in the market. So remember, the stock market is not for you to commit to and be in it forever. You've made some money. Now it's time to use that money for your financial obligations. We said recently that, we could be seeing Dow 40,000. Well, now that the Dow closed at 37,500, okay, let's pop into the screen here. Now that you see that the Dow is up another 251 points and it's 37,500, talking about 40,000 is not really a long way off. It's less than a 10% move from here. NASDAQ broke through 15,000. It's not the first time it's been through 15,000, but it's the first time in probably almost, 2 years or so. S&P 500 is maybe 0.5% to 1% away from reaching an all-time high. Gold has been trading around 2,000, 1,900 to 2,100 for a while. I don't, until we see a breakout, I don't think it's really worth spending a lot of time on it. Oil has rebounded from about 67, 68, 69 in that range back to 73, and that is on worries of friction in the Middle East. Not worries that the war spreads to a wider region, but worries that oil flow is impacted, but that would actually slow the economy and help in some ways reduce inflation, even though oil is going up, which hurts inflation, which causes more inflation. The 10-year yield off a little bit, continuing to stick around the high threes. We could see 3.8 handle on that very soon. And the VIX was down. The VIX volatility index is 12.5. Some people would say that is complacency level and everybody is just kind of complacent, enjoying the holidays, watching the market go up every day. I'm not a seller, I'm a buyer because I have a long way to go. I have years ahead of me of investing. But like I said, the VIX is, to me, signaling a little bit of complacency. And when that happens, we could be due for a pullback. What could cause a pullback? Well, we have to follow the numbers and see how employment figures come out, inflation figures come out, retail sales figures, etc. If things in the economy slow down too fast, and we start having worries about recession again after the market's gone up a lot, well, that would be a reason for the market to go down. See, 3 months ago, 2 months ago, recession worries would help interest rates go lower, especially long-term rates. Stock market would go up. But that's already happened. Stock market went up and interest rates went lower on the long end, long-term rates. So it's already happened. So now we need the scenario to play out as expected or better than expected, not worse than expected, or otherwise, I think we're set up for some give back. How much of a give back? Who knows? But we'll take a look at possibilities. So, after the close today, FedEx came out with numbers, quarterly numbers, and they were pretty bad. So the stock is down almost 9% after market trading, down about 24 bucks. Took a long time for that stock to climb back from its 52-week low. In sympathy, after market trading, UPS is down about almost 3% in sympathy with FedEx, even though they're different companies and UPS is a much, much bigger company. Let's take a look. Another story of the day, CD rates are dropping. Here's where to find the highest payouts. You can go check this article out yourself on CNBC. The point I'm making, the point that we've been making for a while, is that if long-term rates come down, you're going to wish you had already bought some long-term bonds or longer-term, longer-dated CDs, that sort of thing. It's almost, well, it's hard to fight this. Why should I invest in a 10-year treasury that was 5% or almost 5% yield when I could go into a one-year treasury or a one-year CD or a savings account or a money market that pays 5%? Why should I tie up my money for 10 years for 5%? Because the short-term accounts, products, when those go down, you'll still be if they go down, you'll still be collecting your 5% from the longer dated securities for a long time. So in that case, it would have been a good idea, if you believe in diversification, you diversify your duration, your time horizon with bonds, then you could see why it's important. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. A couple of other things to highlight, and I could get into the official Wall Street commentary and all that, but I'm going to skip that. I want to show you something else right here, okay? All right. This here is a picture of the Middle East, okay? Here's Israel. Here's Saudi Arabia. A lot of people can't find these on a map. So here's Iran, bordering Iran is Afghanistan, all right, and Pakistan. They share a border with Turkey, as is Syria and Iraq. But if you look over here, here's Israel. The only thing that separates Israel and Saudi Arabia is right over here, there's Jordan. And then at the southern part of Saudi Arabia is a country called Yemen. I don't know if you call Yemen a failed state. I think in a lot of ways you could. And Yemen has the Iranian-backed Houthi rebels, which are now shooting drones into this little spot, the Red Sea. And this and this is causing havoc in shipping lanes. But if you don't use the Red Sea, that means product has to go all the way around South Africa. And it causes delays, it causes supply chain constraints. How long does this go on? It's hard to say. And if the Israeli-Hamas fight ends tomorrow, there's no assurance that the Houthis stop wreaking havoc in the Red Sea. But let's look at who this hurts. It hurts all of us because it could cause inflation to go higher because it makes shipping more expensive. It takes longer to move goods around. The global supply chains become less efficient. Doesn't affect everything, but it affects a lot. Not, a small amount of global volume is going through the Red Sea compared to the other waterways, but it does change the equation and brings into the world some uncertainty. Maybe China will do something in the South China Sea, and when something happens in one part of the world, when something happens that's bad in one part of the world, our adversaries are pretty good at making something bad happen in another area of the world so they could really distract us and try to dilute our attention. So this is the Red Sea. You should know where it is. Okay. we'll see what happens with the Red Sea, and it's going to take a lot of time. But this is a very narrow waterway. Who gets hurt? Probably, most likely, it's China that gets hurt. It's Europeans that get hurt. But the U.S. has very, very solid supply of oil. We were a net exporter. We don't need Middle Eastern oil. And even when the U.S. was a net importer, the U.S. still got most of its oil from the West, from the South America, from Venezuela, Mexico, and Canada. So the Middle East is not a particularly great partner when it comes to oil. And we really don't need them anymore for oil. But unfortunately, our allies do. But then again, so does China. Okay, so you should be aware of that. That is about it for the show. I thank you for watching. I'm going to get going. And tomorrow, I'm going to be talking about the official Wall Street forecasts from all the big firms, what they're saying, what the market could do, where it could go. And I think it'll be interesting to watch. So have a great day, everyone. And thanks for watching.